Welcome to the channel. Today we're challenging a popular belief that a single total U.S. stock market fund is the safest, smartest core of your portfolio. We'll reveal why concentrating in one country, no matter how strong, adds uncompensated country risk that doesn't reliably pay you more. Then, we'll show how to go global, how to age-proof your portfolio with bonds, and how to keep things simple with a set-it-and-forget-it approach. Stay with me as we move step by step from the myth to the method. Here's our plan. First, we define uncompensated country risk and why it matters. Next, we show the global diversification fix. Then, we build a simple 3-fund portfolio and see how it changes as you age. After that, we lock in the golden rule that protects you from emotional mistakes. Finally, we'll reinforce learning with 2 quick quizzes. Concentration in a single country exposes you to political, regulatory, sector, and currency-related shocks tied to that market. Historically, some dominant markets underperformed for decades. Because investors can diversify across countries at low cost, taking single-country risk doesn't reliably increase expected returns. That's what we call uncompensated risk. The good news is that the fix is simple and accessible to everyone. Let's define terms. A compensated risk is one that historically rewards you with higher expected returns. Think overall equity risk. But a country-specific risk, like holding only one nation's stocks, can be diversified away by owning multiple markets. Since diversification is cheap and easy, that concentrated country risk is considered uncompensated. You're taking extra risk without a reliable expectation of extra returns. That's the core issue with relying exclusively on a U.S.-only fund. To mitigate uncompensated country risk, broaden your equity exposure beyond the U.S. by owning international stocks. A practical rule of thumb derived from global market capitalization is to hold roughly 40% of your equity allocation in international stocks. Alternatively, consider an all-world fund that automatically weights countries by their global share. Either approach maintains diversification without complexity. How much should you allocate abroad? A simple approach is to put roughly 40% of your equity slice into international markets. For a pure stock portfolio, that's about 60% US and 40% international. If you hold 70% in stocks and 30% in bonds, then apply the 60-40th split inside the stock portion. 42% US, 28% international, and 30% bonds overall. If you prefer simplicity, use an all-world fund that automatically rebalances the country weights in line with global market capitalization. On the left, a home-biased portfolio concentrates risk in one economy, making you more sensitive to local policy, sector concentration, and prolonged underperformance. On the right, a global allocation spreads exposure across many economies and currencies, reducing volatility from country-specific events and allowing you to benefit from multiple growth engines. The key is that the right-side approach diversifies a risk you don't need to bear in isolation. Here are the 3 building blocks. A U.S. total market fund captures broad U.S. equity exposure. An international total market fund covers developed and emerging markets outside the U.S. An investment-grade bond fund provides income and reduces overall portfolio volatility. The equities are higher risk in return, while bonds generally dampen volatility and help stabilize the portfolio, especially as you approach and enter retirement. To implement the 3-fund approach, first select low-cost total market index funds for U.S. stocks, international stocks, and investment-grade bonds. Next, decide your overall equity-to-bond split based on your tolerance for volatility and your time horizon. Within the equity sleeve, consider around 60% US and 40% international, or simplify with an all-world fund. After that, automate your contributions so you stay consistent, and rebalance on a defined schedule annually, or when allocations drift by a set threshold. Finally, ignore market chatter and stay disciplined for decades. Early in your investing life, you may tolerate a full equity allocation across U.S. and international stocks. However, as you close in on retirement, it's prudent to add high-quality bonds to reduce drawdown risk and smooth volatility. One illustrative allocation is 60% U.S. stocks, 15% international, and 25% bonds, with bond exposure gradually increasing over time. Near retirement, many investors shift toward a 50-50 or 40-60 stock-to-bond mix, depending on their risk tolerance, spending needs, and overall financial plan. This pie chart illustrates a simple approximation of the global equity market capitalization. around 60% US and 40% international. The exact proportions can shift over time, but the point is that international markets represent a substantial portion of global equities. Aligning your portfolio roughly with this split helps avoid country concentration. This flowchart lays out the decision process. You begin by determining your risk tolerance and time horizon, which yield an initial equity-to-bond split. If you're young, you may favor higher equity. If you're near retirement, you favor more bonds. Within the equity portion, you either split about 60% US and 40% international, or opt for an all-world fund. Then you automate contributions, rebalance periodically, and most importantly, stay the course to let compounding work. This timeline shows an illustrative glide path that gradually increases bond exposure as you age, from 90/10 at age 25 to 50/50 or 40/60 by age 65. Actual choices depend on personal circumstances, but the theme is consistent. Add stability as retirement nears so that market volatility has a smaller impact on your lifestyle and withdrawal plan. Quiz time. Which statement best describes uncompensated country risk? Option A. Extra risk that reliably boosts long-term returns. Option B. Risk you can cheaply diversify away, so it doesn't reliably pay you more. Option C. Currency risk that always increases returns. Option D. Bond risk that disappears in retirement. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is B. Uncompensated country risk is a risk you can diversify away at low cost. Therefore, holding it in concentrated form doesn't reliably provide higher expected returns. Second quiz. If your total portfolio is 70% stocks and 30% bonds, and you place 40% of your equity allocation into international, what percent of the total portfolio is international? Option A, 14%. Option B, 28%. Option C, 40%. Option D, 70%. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is 28%. You take 40% of the equity sleeve, which is 70% of the total portfolio, resulting in 0.40 times 0.70, or 28% international overall. The golden rule is to set your plan and let it work. Don't confuse complexity with sophistication. More funds don't guarantee better outcomes. In fact, complexity often creates mistakes. Automate contributions, rebalance on a schedule, and resist the urge to react to every headline. Your edge comes from discipline, broad diversification, low costs, and time in the market. These are the essentials. Avoid uncompensated country risk by diversifying globally. Target roughly 40% of your equity exposure abroad, or use an all-world fund. Implement the simple 3-fund portfolio with bonds increasing over time, and enforce discipline through automation and scheduled rebalancing. This content is educational and not personalized financial, tax, or investment advice. Your circumstances are unique, and you should conduct your own research and consider discussing decisions with a licensed professional before acting. To wrap up, single country portfolios add unnecessary, uncompensated risk. Global diversification is straightforward and effective. A basic 3-fund portfolio keeps costs low and coverage broad. As you approach retirement, gradually add bonds to reduce volatility. Above all, set your allocation and stick with it for the long term. Thanks for watching. If you found this helpful, please like the video, share it with someone who needs to diversify, and subscribe for more straightforward investing content. Drop your international allocation and what funds you use in the comments. I'd love to hear your approach.